Donald Trump, US president, no longer needs help from NATO allies to wage his war against Iran as countries increasingly rule out participation. Also, Joe Kent, one of America's top counterterrorism officials, resigned in protest concerning the war. Although many view the US-Israel military action against Iran as indicative of unstable leadership in the White House, polling data indicates it has consolidated support among the president's dedicated base. We also just got the latest wholesale or producer price inflation reading for February, coming in higher than expected. Month-on-month increase was 0.7%, higher than last month's 0.5% and 0.3% expected. Year-on-year PPI, producer price inflation, at 3.4% also beats 2.9% expected. All the instability emanating from the White House could be unleashing a fresh wave of concern for central banks. US Federal Reserve Chair Powell had the opportunity to weigh in on the debate on how all this will affect inflation in the world's largest economy as interest rates are left unchanged at today's Federal Open Market Committee meeting.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision.
The US Fed held rates at 3.5 to 3.75%, citing resilient growth and elevated inflation. None of the FOMC voted for a rate hike, which looks dovish. The summary of economic projections also showed slightly higher growth in the US economy in 2026 to 2.4%, and in 2027 also higher at 2.3%. The PCE inflation projection is now also going up to 2.7% from a previous 2.4% projection. The federal officials expect just a 0.25 percentage point rate cut in 2026 and an additional 25 basis points in 2027. Hello, this is Global Business Insights, where we look at the world from a business perspective and bring you news, views, and analysis that helps to get you up to date on the context. Disney has announced major changes to its organizational structure as Josh D'Amaro assumes the role of CEO, succeeding long-serving chief Bob Iger. Under the new arrangement, Disney's entire creative division will be overseen by Dana Walden, who will report directly to D'Amaro. This move seeks to integrate Disney's film, television, streaming, and gaming segments under unified leadership, consolidating content operations into a single division. The restructuring also appoints longtime executive Deborah O'Connell as chair of Disney Entertainment Television, granting her oversight over television operations. These measures come as Disney continues to lead the global box office with 3 films exceeding $1 billion in the past year and sustained dominance for 9 of the last 10 years, while further expanding its presence in streaming and gaming. Still on central banks, after a narrow 5-4 vote, the Reserve Bank of Australia increased interest rates by a 0.25 point, citing inflation risks from the Iran war. The sharp rise in fuel prices has driven additional uncertainty, even though some analysts insist the impact based on previous oil price shocks tend to be transitory. Markets remain focused on what's going on with oil prices as Ukraine's President Volodymyr Zelensky urged countries not to ease sanctions on Russian oil. Still, volatile oil prices fell earlier today as exports resumed from Iraq's Kirkuk fields to Turkey's Ceyhan port via pipeline, providing some relief to global markets. With little signs of a de-escalation of the Iran conflict, Brent futures prices appear to have settled over $100 per barrel in the last 4 consecutive sessions. Analysts remain hopeful that the most likely scenario is a transitory jolt as combination of fair premium and supply short-ins push up prices. Last week, Julius Baer updated its own analysis on the energy shock currently playing out. In their latest report, they see the current escalation likely to be a temporary shock to energy flows. The base case shows prices surging on precautionary trade disruptions rather than on an irreversible supply loss. But analysts also argue that production shut-ins may reach 75% in affected areas, yet spare global storage and limited infrastructure damage constrain the upside for oil, barring further deterioration. The base case at over 60% probability favors a sharp but short-lived spike, warranting measured resilience over broad de-risking or tactical exits. It says longer-term dynamics remain anchored in normalization as renewed supply steer prices back toward the low $60. We could see a more enduring and chaotic scenario, 30% probability, with prices between $60 and $70 a barrel, while there is a slim 5% chance of sustained panic and crisis, with Brent crude lingering over $100 per barrel. In Germany, plans to encourage investments in data centers to at least double domestic capacity and to boost artificial intelligence data processing at least fourfold by 2030 were announced. Digital Minister Carsten Welsberger has proposed a range of measures, including dedicating land for development in its bid to catch up with the dominant players, United States and China. In Nigeria, analysts are updating expectations on inflation, now seeing 2026 ending the year with inflation at about 22%. This comes after pricing in the anticipated impact of the ongoing war in the Middle East on global supply chains, especially on energy and food prices, as well as the impact of election-related spending on 2026 liquidity levels. Before the war, the market was seeing inflation in 2026 averaging 12 to 13%. Significantly higher inflation also is likely to weigh on GDP growth projections. Also, Nigeria's president on a state visit to the UK has described the recent assault on Maiduguri by coordinated suicide bombers as the final desperate acts of militants trying to spread fear. President Tinubu yesterday said he had approved additional equipment and support for the military, which he promised would completely defeat the militants. Trump had criticized Tinubu's trip to UK as ill-timed, but it's not clear if the US military would be involved in any response to the bombings as seen in previous cases where it was also reported that the US military was providing aerial surveillance intelligence. In South Africa, annual inflation slowed in February to 3.0%, reaching the central bank's target. That is from 3.5% in January, also slightly lower than expected. South Africa's central bank had kept its key lending rate unchanged at 6.75% when the Monetary Policy Committee met in January. To bring down oil transportation costs, President Trump issued a 60-day waiver of a long-standing U.S. shipping law, the Jones Act, that requires that the transport of goods between U.S. ports must be conducted by U.S. vessels. This will allow vital resources like oil, natural gas, fertilizer, and coal to flow freely to U.S. ports for 60 days. South Korea's Kospi-led gains in Asia as investors assessed Japan trade data and awaited U.S. Federal Reserve's interest rate decision. Japan's Nikkei 225 jumped 2.87% after the country reported that exports climbed 4.2% from a year ago in February, beating estimates. European stocks were also broadly higher. Well, that's all we can take on this special edition of Global Business Insights. This is Bodio Shosami. Thanks for watching. Bye-bye.